Over the past few months, interest rates in Singapore has been going down and down and down. Just earlier this year, the 6-month Treasury bill was yielding almost 3%. Today, that yield has dropped to less than 1.5%. And it's not just T-bills. Singapore savings bonds, fixed deposits, bank interest rates, and even cash management accounts have all followed the same downward trend. Which brings a question: where else can income-seeking investors continue to earn a decent return without taking on too much risk? One answer is to look into bond funds, and among them is the LionGlobal Short Duration Bond Fund. While the unit trust version of this fund has been around since 1991 and is probably older than some of you guys, LionGlobal will be launching the active ETF version later this month. With this ETF, you get a convenient way to invest into bonds while still getting a potential yield that is higher than today's rates. In this video, I'll walk you through everything you need to know about the LionGlobal Short Duration Bond Fund. We'll cover what the fund is all about, what it invests in, and the fees and risks you should be aware of. I will also be comparing it to other popular bond funds and ETFs to see how it stacks up, and more importantly, which one might be the better choice for you. And finally, I will also show you how you can invest in this fund, along with the promotions available during its launch. So let's do a quick walkthrough on what the fund is about. The objective of the LionGlobal Short Duration Bond Fund is straightforward. It seeks to deliver a total return of both capital growth and income over the medium to long term. To measure its performance, the fund uses the 3-month SORA plus 0.35% as its benchmark. Or, in simpler terms, the fund's goal is to beat what you would normally earn from a near risk-free short-term rate by a meaningful margin. Looking at its track record, the fund has managed to do just that. Since inception, it has delivered an annualized return of 3.7%, significantly outperforming its benchmark of around 1.8%. Part of the reason it was able to achieve that is due to its active management approach. Unlike most ETFs that simply mirror an index, this ETF is actively managed by a team of fund managers who can actively shift holdings dynamically to seize opportunities while limiting risk. As of 31st July 2025, the fund holds 227 fixed income securities, which makes this a fairly diversified basket of bonds. Close to 40% of its holdings are in Singapore bonds, while the rest is spread across markets like Hong Kong, France, the US, and other developed economies. From a sector perspective, the fund leans heavily into financials and real estate, which together make up more than half of the portfolio. There's also a modest allocation to sovereign bonds and industrial names, which may help to diversify the risk even further. On the quality side, the fund carries an average credit rating of A-. This puts it within the upper medium grade territory. And more importantly, since this is a short duration fund, the average portfolio duration is just 2.25 years. What this means is that the fund is less sensitive to interest rate changes as compared to longer term bond funds. So if the rates were to suddenly move up or down, the effects on this portfolio would be relatively smaller as compared to a longer duration bond fund. You can really see this play out in the fund's history. During periods of market stress, the fund has generally held up quite well. For example, the Fed taper tantrum of 2013, the Fed turbulence of 2016, and even the Treasury yield surge in 2018. The fund's drawdowns were all capped at less than 3%. The only time the fund experienced a significant drop was during the rapid Fed rate hikes of 2021 and 2022, when global bond markets were hit hard by the fastest tightening cycle in decades. Even then, the fund eventually recovered as rates stabilized. In other words, if you had stayed invested instead of panic selling, you would have been able to ride out the downturn while getting paid a regular income. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Speaking of income, the ETF intends to pay out quarterly distributions in March, June, September, and December. But of course, there's a caveat that distributions are not guaranteed lah. Next, let's talk about the fees. The ETF version of this fund charges a management fee of 0.25% per year. This is much lower than the 0.5% charged by the unit trust version. But note that the management fee is not the same thing as total expense ratio, yeah? That's because the expense ratio would also include other costs like trustee fees, audit fees, and administrative expenses. To put things into perspective, the unit trust version has a total expense ratio of 0.57%. So, while the ETF hasn't published its official expense ratio yet, given that its management is already half of the unit trust, and ETFs generally come with lower distribution and administrative costs, you can reasonably expect the ETF's total expense ratio to be lower than 0.57%. Now, you might be wondering, what are the differences between the unit trust version and the ETF version, given that both look almost the same? The first difference is in how you would assess them. The unit trust can only be bought and sold through distributors such as banks, financial advisors, or fund platforms. The ETF, on the other hand, is listed directly on SGX, which means you can trade it through any broker with SGX access, just like buying or selling a stock. Besides that, there's also a big difference in liquidity and speed. With the unit trust, all trades are executed at the end of day NAV. So if you place an order in the morning, you won't know the price until the fund calculates its NAV after market close. Meanwhile, the ETF is much more flexible. You can buy and sell throughout the trading day, with prices moving in real time. For investors, that makes it faster and more transparent. Another difference is the minimum investment. The unit trust requires an upfront investment of $1,000 with subsequent top-ups of at least $100. Meanwhile, the ETF has no such requirements. You can start with just one unit, which makes it far more accessible to smaller investors. Finally, there's the question of using CPF and SRS. The unit trust version is CPFIS approved, so you can invest using your CPF ordinary accounts or special accounts, as well as SRS. The ETF version, however, is not eligible for CPF, at least for now. Though, the good news is that you can still invest in the ETF using cash or SRS. Next, here's an interesting question. Why do you even need active management for bond funds? Can't it just passively track an index like the other bond ETFs out there? Well, you could. But active management can actually help investors manage risk more effectively. For example, one of the key risks in bond investing is currency risk. A passive ETF that holds US dollar or euro bonds will leave you exposed to FX fluctuations. But here, the managers actively hedge almost all non-SGD exposure back into Singapore dollars. This means investors don't have to worry about exchange rate swings reducing their returns. Another risk is interest rate risk. Passive ETFs can't control the maturity profile of their bonds, so they may end up more sensitive to interest rates. But here, the fund manager can deliberately keep the portfolio short in duration. This makes the fund less volatile and better able to withstand sudden shifts in interest rates as compared to long-duration bond funds. Finally, there's default risk. Passive indices often allocate more to the biggest issuers, even if they are highly indebted. But here, with active management, the fund manager can actively choose bonds that are of high quality, while applying strict limits to ensure diversification and avoid over-concentration in weaker holdings. Now that we understand how the LionGlobal short-duration bond fund works, let's look at how this bond fund stacks up against other popular bond funds and ETFs like A35, MBH, AGGU, and the Amundi Index Global Aggregate Fund. If we look at the one-year performance, you will notice that A35, which holds many Singapore government bonds, and MBH, which holds a mix of corporate and government bonds, show stronger returns. This is partially because both of these two ETFs have a longer duration. So when interest rates fell recently, it benefited more from the rebound in bond prices. But when you stretch to the 5-year period, both the LionGlobal Short Duration Bond Fund and MBH came out ahead. This is because their shorter duration and heavier allocation to Singapore investment-grade corporates have allowed them to deliver steadier returns through different rate cycles. Which brings the question, is there really a difference between the LionGlobal Short Duration Bond Fund and the other passively managed funds? While they may look broadly similar in holdings and long-term returns, the key difference is that the LionGlobal Fund is actively managed. This gives the managers flexibility to adjust exposure and manage risk, something that passive funds like MBH or A35 cannot do. This flexibility may not always show up in good times, but it can matter a lot when markets turn volatile. And indeed, if we compare them across a 10-year period, you will notice that the LionGlobal Fund, which is the yellow line here, has been much more resilient, especially during the 2021 and 2022 Fed aggressive rate hike cycle. While the rest of the bond funds suffered deeper drawdowns because of the longer duration, LionGlobal's short duration profile meant that it held up better and recovered faster. Finally, if you are interested in investing in the LionGlobal fund, it will be open for subscription from 8 September to 23 September 2025, and it is scheduled to list on SGX on 29 September 2025. There will be 2 share classes available, the SGD class with the ticker SBO and the USD class with the ticker SBV. During the IOP, you can subscribe through participating banks and brokerages such as OTBC, DBS Vickers, Maybank Securities, Poems, and FSMOne. After listing, the ETF will trade just like any other stock, so you can buy or sell it through your regular brokerage accounts. To sweeten the launch, some distributors are offering promotions. FSMOne is giving out $10 cashback for every $10,000 invested, capped at $200. So it's like a 0.1% extra return, which is ain't much, but a bonus return is still a return. This applies to only cash subscriptions during the IOP, with cash and SRS subscriptions available after listing. Meanwhile, Poems is offering $10 cashback for every $5,000 invested, capped at $500 for the first 200 clients who subscribe between 8 and 22 September. And if you don't already have an account with FSMOne or Poems, you can sign up using my links down below to get additional welcome rewards on top of these IOP promos. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.